Hi, good morning, everyone, and thanks so much for joining today's morning cuppa at 8. My name is Gerald, and I will start with a quick update on the Singapore market. Okay, so over the past week, we have seen the Singapore market recovering. We are now back to above 4,200 points for the benchmark Straits Times Index after a 2.1% gain in the past week. So what we see here is with the strong momentum in the US market, the Singapore market has recovered as well. And part of it is also boosted by the strength in some of the company earnings that were reported over the past week. So this is what we see for the Straits Times Index over a longer time series. Effectively, after some of the pullback in the early part of August, we are now actually back to close to the all-time high of above 4,200 points, just slightly below the all-time high of 4,300 points. So in terms of the top performers in the past week, we have got Yangzijiang Shipbuilding as well as DBS, both of which reported stronger than expected earnings. Particularly for DBS, given the very significant weight in the benchmark Straits Times Index, it has actually helped to boost the index. So I wanted to go into a bit more detail about DBS today, to look at its most recent earnings and why it actually led to this 7% bounce. So this is what we see for DBS's share price, reaching a new record high of above $50 per share, following the report of its second quarter earnings. What we saw for the second quarter earnings is that the net profit grew by 1% year on year to 2.8 billion. Across the board, we saw strength in the earnings, where the total income grew by 5% year on year, and the profit before tax also grew by 5% year on year to 3.4 billion. So one of the reasons for the bounce in DBS's share price is that with the fall in interest rates, investors were expecting that the earnings would actually come down, given the fall in the net interest margin. So in case you're not familiar with this concept of the net interest margin, it is effectively the profit margin that the bank make by giving out loans. And typically, with the interest rates falling, the net interest margin will also then come under pressure, as some of the loans that are made would then not be as profitable as before. So we do see that the net interest margin has come down to 2.05% in the second quarter of this year, from 2.12% in the previous quarter and 2.14% in the previous year. However, with the loan growth that we have seen for DBS, it has still been able to maintain its net interest income at about 3.6 billion. Okay, so this is about flat compared to the previous year as well as the previous quarter, despite the fall in the net interest margin. But more significantly, it has been able to grow its fee income, and that actually drove the 1% growth in the net profit. So what we see here is that the fee income was at 1.4 billion in the second quarter, which is an increase from the 1.26 billion in the previous year. A big part of the growth in the fee income is driven by the growth in the wealth management fee income, which increased 25% year on year to 649 million. So with the very sharp growth in the wealth management fee income, the overall fee income rose by 10% year on year. In case you're wondering what is leading to this growth in the wealth management fee income, part of it is driven by the more buoyant capital markets activity, which actually led to clients in the wealth segment undertaking more activity, but it's also been able to attract more asset under management into its wealth management business. So overall, we saw that the non-interest income grew by 11% year on year. I mentioned part of it is driven by the fee income, which rose to 1.2 billion. But with the growth in the other non-interest income, with the markets trading, that overall led to an increase in the non-interest income of DBS, which helped to drive the higher profit for the entire group. So with the strong earnings that were reported by DBS, I think what many investors were looking out for is also the dividend payout. So what we see here is an interim dividend of 60 cents per share, plus a capital return dividend of 15 cents per share. And with that, in the first half of the year, they will be paying out a total dividend of $1.50, which is representing a fairly significant growth compared to the dividends that were paid out in the previous year. So in terms of the outlook that the company has given, overall, they are expecting that the group net interest income will still end up slightly above 2024 levels, despite the fall in the interest rate. So that is driven by the loan growth that we have seen that is helping to offset some of the decline in the net interest margin. So I think that is taken positively by investors who were previously concerned that the net interest income might be under pressure. So if I were to look at the valuation of DBS currently, it is at 2.2 times price to book, which is above the historical average. But that is mainly driven by the higher return on equity that the company has been able to make, justifying this higher price to book valuation. But what is important to note is that the current dividend yield of DBS remains high at about 6%. And that is based on the $1.50 dividend per share in the first half of this year. Annualizing that would be at about $3 per share. So that means that even with the record high share price of DBS, it is still offering a dividend yield of close to 6%, which is above the historical average and also above the dividend yield offered by the Singapore Benchmark Straits Times Index. So all in, we see that DBS results has surprised positively. Firstly, the net interest margin has come down, but with the loan growth, it's been able to keep the net interest income stable. It's been able to grow the fee income with the growth in the wealth management fee income. And with that, it has been able to pay out a high dividend of about $1.50 in the first half of this year, translating to a dividend yield of close to 6%. So in a nutshell, that is what is driving DBS's share price to a record high and also helping to boost the Singapore Benchmark Straits Times Index. Okay, so with that, I'll end my sharing on the Singapore market and hand over to our next speaker who will give an update on the Malaysian market. Thank you so much.
All right. Morning, everyone. Thank you, Gerald, for the sharing on the DBS. So let's take a look at the Hong Kong market, and as of yesterday, right, the Hong Kong market have resort to some sort of corrections, and right now it's trading slightly below the 20 days moving average, showing that the momentum have slightly decelerates, but overall, the Hang Seng still remains above the 23,000 point level right now. Just look at the HXC, right? Based on the Monday, right? It still remains above the 50 days moving average. And for the past 1 week, HXC have managed to rebound from this hammer pattern and is charting a small rising wedge right now. So if this week the HXC follow through and climb above the 20 days, then the technical setup will be improved again on this Chinese stock that lists in the US market. Now, basically, for the last 1 week, you can see that the some of the big cap stocks of in the Hang Seng it's actually going two different directions. Firstly, we look at the tech stock like Xiaomi. Initially, it was moving upwards above the 57, and past 1 week, it resort to a corrections right now, and it had actually had a gap down and now close below the 52. So look at this price volume um, distributions. You can see that quite a lot of volume are being traded above the this 52 level. So this 52 level has turned from a strong support become a strong resistance. So 52 and 57, this band has become a resistance for Xiaomi, and naturally Xiaomi will go for corrections to build a consolidation base. It should be somewhere at 47 and 50 cents. Now, nevertheless, in the support level like 47 or even 42, these are the two levels that the counter will tends to have a rebound. So in this kind of situations, when the stock is actually going for corrections, we still can adopt a buy low, sell high strategy to wait the stock at the support level and see how the price actions form. Okay. And then on, if you're looking for some momentum or you want to look for the upside stocks, then we can look at HK Hutchinson, where the stocks under the Li Ka-shing team. And you can see that not only stock number 1, stock number 5, stock number, these are CK assets actually have been trading on a higher high recently. Despite the market have quite volatile recently, right? The shares have maintained quite well above the 20 days moving average, and right now it's heading towards 52 and followed by the 56 level. Secondly, looking for a small cap counter, right? One of the counter is a Modern Dental, right? And the share price have break past 4 Hong Kong dollar 40 cents and heading towards $4.60 and followed by $4.80. Of course, today you look at the Modern Dental, the share price have moved up. Then you text me why I didn't join you on these stocks, Bojo, right? But actually, if you look at our watch list, right, this Modern Dental have been a watch list for a very long time, right? One of the dealer that I talked to recently, he says that every morning, when he wake up or log into Morning Kappa, he will actually watch on our watch list, see what are the stocks that we added or we delete off from our watch list. But you can see that for quite some time, Modern Dental has been in a watch list for some time. I hope you continue to come into our Morning Kappa and look at some of the stock that we actually pre-filtered for you. And all you need is actually to look at the technical picture, right? And then based on the momentum, I see that Modern Dental still have some upside to move, right? And on the downside, support will be at 430 and followed by 415. As for the Euro market and US market, the sentiment are quite neutral right now, pending for more news, especially this week. Market is actually waiting for Donald Trump's latest plan on this semiconductor and pharmaceutical tariff. And of course, this week, US and China supposed to have end their 90 days truce. And let's see what's the new deal made between US and China. So this is a watch list for the US counters, and nothing much change. And just want to catch up on some of the big cap stock like Apple. Right, last week after Apple mentioned that they are going to up their investment in the US, and you can see the share price have actually break past 225 resistance. So after the breakout yesterday, the stock actually have a mild pullback, but still above the 225. Looking at the price volume, right, this indicator, you can see a very strong support have established and a 212 and also the 200 level. Looking at the all the Magnificent Seven counters, Apple is one of the laggards year to date compared to Nvidia, Microsoft, and so forth, right? And but you can see that last 2 days momentum is actually quite strong, and sentiment have become positive on the Apple stock. Secondly, the one of the most talked about stocks will be Tesla, right? And the share price has been whipsawing and up and down But they also look at the price volume since last year, November until today, right? November is where the Trump went into the office. That's where the Elon Musk have very strong close relationship with Trump. Of course, right now things have become a little bit edgy between them. But you can see that the strong resistance is actually at 330. Now, normally when we see a resistance, the share price tend to have a corrections. But right now, Tesla have the share price have penetrates into this resistance zone. This signal actually tells us that the resistance is not as strong as what we thought, right? If the share price move a higher high, then on, I think that the sentiment will become more positive on this counter again. Despite that, yesterday there's a shooting star here, right? I think that overall technical picture still quite looks bullish on the Tesla discounter. Okay. Now, nevertheless, on the downside, support is at 280, right? Anything above 280, I'll keep my bullish bias. Once it break the 280, then on we'll confirm this is a resistance zone, and then on the shares will be going for corrections. Okay. So right now, I will stay on the bullish side since the stock have penetrates into the resistance zone. Now, another counter that have a very strong momentum with actually EA, right, Electronic Arts, and this counter have been publishing video games that we are familiar with. Start off from FIFA, I think until recently is the Battlefield. And based on the share price, you can see that the strong support have established somewhere at about 148, right? And right now it's heading towards 180 and followed by 200 US dollar. As for another counter that we want to catch on the low side would be the AB&B. Now, this counter last week, they have announced their results. Results have beat expectations on the top line and bottom line, but the company guided that on the quarter three and full year, things may not be as rosy as we thought, and the company tends to be a bit on conservative, and share price have actually came down after the results. But I just want to mention that based on what they have achieved in the year 2024 and also the first half of this year, 2025, the top line is actually growing at a very fast CAGR, right? And they have did something very correct, that their revenue growth have actually outpaced their peers, such as Booking.com and the rest. And their margin have been actually quite stable over the time. And good thing about this company is that they have not much capex and such. This company is generating enormous amount of free cash flow. So you can actually look at the some of the Wi-Fi website on their fundamentals, but I will actually recommend you to actually look at their cash flow and how this company generate their revenue over the last 2 years. Okay, and this shares right now is trading at about 120, and sooner maybe they go to 112 and 100, and this is where I think the opportunity stands once it go below 120. Okay, and then we just look at the levels to catch on the technical rebound. And let's move to a Malaysia market, and you can see that last week we have mentioned that the FPM KLCI remained a bullish setup as counter still the weekly chart above the 20 weeks moving average, and true enough, the FKLI have climbed above 1550. Okay, so we keep a bullish bias with the stop loss point at 1500. Then on the FCPO, right, we keep our stop loss at 4001, and right now the FCPO have climbed above the 200 days moving average, showing that a very strong momentum in play right now, heading towards the next resistance 4004 and followed by 4005. So afterwards, Iftaar is going to share with us on the MPOB report. And before I pass on our trading stocks today, firstly, Gerald Plantations, JPG, break past 1 ringgit and 30 cents on the back of high volume. And GBG is heading towards 1 ringgit 40 cents and followed by 1 ringgit and 45 cents. Downside support is 1 ringgit and 25 cents. Secondly, we have the VST ECS. that break past 3.40, also on the back of high volume. So the breakout VST is going to test the 3.60 and followed by 3.80. Downside support is 3.20. Okay, so I'll stop here and pass on to Iftaar on the plantation sector report. Thank you.
Yep. Thank you, Joseph. So, good morning, everyone. We have a plantation sector update. So, I'll start with the results preview first, and then we move on to the monthly stats. So, for this coming quarter, we expect earnings to moderate Q on Q as CPO prices fell 14%, while PK prices slipped 6% Q on Q. And although this will be somewhat offset by the improving FFB output, as for Malaysia planters, they saw an increase of 17% Q on Q in terms of output. On a year-on-year basis, planters should also see higher earnings. In Malaysia, output improved 5% year-on-year, and CPO and PK prices also improved 1% and 40% respectively. So, meanwhile, however, for Indonesia, while CPO prices were down 4% and also output was flattish, PK prices improved 13% year-on-year. So overall, for this coming set of results, we expect 7 planters to record largely inline earnings. And given their estimates of FFB production and as well as the moderating CPO prices. So we note that 3 planters have released their results, namely Lada Sumatra and Astra Agro in Indonesia, and SD Katri in Malaysia, of which two of them beat our estimates. So just quickly moving on to the stats, July production improved 7% month-on-month, and this brings the year-to-date July growth to plus 1% year-on-year. So moving forward, we still are expecting Malaysia to continue improving towards the second mini peak in the third quarter. So exports meanwhile slightly improved to 4% month-on-month, and this brings the year-to-date July export growth to minus 10% year-on-year. So this month-on-month increase was mainly driven by the attractive CPO prices as it traded at $222 per ton discount to soybean oil and $178 per ton discount to sunflower oil on average in July. However, even though we expect CPO exports to continue increasing on the back of the competitive prices now, we highlight that the buying activities will still likely lean towards Indonesia palm oil, and this is given the fact that Indonesia palm oil has a more advantageous tax structure of 18% versus Malaysia's 10%. So if you were to buy palm oil from Malaysia, say at 4,000 ringgit, so your net prices will be 4,000 ringgit minus 10%. Meanwhile, for Indonesia, it's 4,000 ringgit minus 18%. So that makes Indonesia palm oil more attractive to price-sensitive countries like your India and also China. However, for EU, for example, even though the price for Indonesia palm oil is cheaper, but we have an advantage in terms of our ESG, which have higher credentials than them. Because as we know, EU is known for its ESG compliant products with the upcoming EUDR. So overall, July stock levels increased 4% month-on-month to 2.11 million tons. And we expect stock levels to keep increasing above the 2 million ton mark as we head towards the peak output in the third quarter. So overall, we still maintain neutral on the stock as we believe fundamentals are now more balanced, as even though supply are increasing, but then demand should also see improvement from the attractive CPO prices. So our top picks remain SD3. For Malaysia, our top picks remain SD3, Sarawak Oil Palms, JPG, And for regional players, it's FR, which is First Resources, and as well as London, Sumatra. So I'll stop here. Thank you so much, everyone, and have a nice day. Bye bye.